GigaCloud technology stock is underperforming in 2024, especially over the last month and a half since the company helps facilitate the outsourcing of manufacturing to countries like Asia and then shipping it back to the United States where companies facilitate the resale of those goods. And given how the incoming administration is planning to raise tariffs for outsourcing and imports, the company was already under question, and that just triggered even more concern from investors. But in this video, I'm going to argue why, despite those risks, why this stock is so undervalued that it could be a good risk versus reward for investors heading into 2025. I'm going to share with you the company's revenue growth, improvements in profitability and cash flow, and the ridiculously cheap valuation on why investors can take a chance on this admittedly risky investment heading into 2025. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. So you can see the price action here for GigaCloud technology stock trading at below $20 a share now at $19.69. You can see since the November election results, the stock price has taken a bigger step downward after it was showing some recovery there before October and now showing bigger declines here. It's now approaching its all-time low here for 2024 at about $16 a share. I think it's a good opportunity for investors. Let me share with you my reasoning. So first of all, the company has demonstrated solid revenue growth. Some of that is due to acquisitions the company made, but it used cash flow that it generated from operations to make those acquisitions. It wasn't stock-based acquisitions the company made. In the latest quarter, 68% year-over-year revenue growth and several consecutive quarters of over 60% revenue growth here for this company. You typically wouldn't find this kind of revenue growth for a company at these valuations. I'm going to share with you how cheap the shares are trading at. You typically don't find growth at this level with these kinds of companies. Similarly, its cash flow from operations have been improving and were solidly positive, 12.65% in trailing 12-month cash flow from operations. And I already highlighted that the company utilized some of its cash flow from operations to make 2 acquisitions this year. Those acquisitions will help the company increase its presence and generate more revenue as it's already been generating thus far. Similar story with its operating profit margin rising to 12.98% in a trailing 12-month period, growing from a little over 6% in 2022. So you have a company that's growing revenue significantly, generating double-digit cash flow from operations and operating profit margins. Admittedly, the revenue growth rate is slowing down. The cash flow from operations and operating profit margins are worsening. The trend line is downward in recent quarters, but still these numbers are positive and over double digits. And given the really cheap valuation, I'm not going to be picky with these numbers here. If the price was very expensive, that's when I would be really picky, right? Similar to when you go into a store and you're looking at a t-shirt or a sweater or a jacket and it's selling at a super premium price, you're going to be really picky about it. You're going to want the perfect fit. You're going to want the exact color you're looking for. Everything else has to be perfect if you're going to pay that super premium price. But if you're going to get a jacket at a really low price, you're going to be willing to accept maybe a color that wasn't your first choice or your second choice. You're going to be willing to accept the fact that maybe the fit is not exactly the way you want it, right? Price determines a lot of what you're willing to accept in a product and in an investment. If you're paying a premium price, you've got to be extremely picky. If you're paying a really, really cheap price, you've got to overlook some of those factors and try and determine if the low price makes it worthwhile to accept some of these less desirable characteristics. Return on invested capital is actually a very attractive characteristic for GigaCloud technology at 40%. This is a return on invested capital you would see with a premium priced investment, not one that's trading at a forward price to earnings of less than 10. So you don't see these kinds of numbers for companies that are trading at these valuations. And the improvement is also in the favorable direction, rising from 15% all the way up to 40%. And I told you that the stock is really cheap. And when you look at the forward price to earnings ratio, GigaCloud Technology is trading at a forward PE of just 4.8. Just 4.8. This is a really cheap valuation. Now, there are reasons for that, as we shared in the beginning of the video. The geopolitical risks, the declining margins and cash flow from operations, which are likely to continue, but you're getting this business at a forward PE of 4.8. Now, when we look at Wall Street analyst estimates for the company's free cash flow, they're not expecting significant growth, but they're not expecting significant declines either. The company is forecasted to generate $130 million in free cash flow in 2024, and that's expected to grow to $200 million by 2028. So less than double in the next 4 years, which is not incredible growth, but it's growth. And you rarely see growth in free cash flow in businesses trading at a forward PE of less than 5. So you're getting all of those characteristics with a business that's trading at a ridiculously cheap valuation. Now it's trading at $19.69, which is down from the over $40 per share it was trading at around February and March of this year. Everything that I've covered in this video points to a business that should be trading at a much more expensive valuation, in my opinion, but it's not. The geopolitical risks and the fears of the slowdown have got this stock trading at a very low price. So for all those reasons, I think GigaCloud Technology is one stock, albeit risky. It is risky, right? It's very uncertain how all these geopolitical risks will play out for GigaCloud Technology, and it might be significantly negatively impacted. But if it's not, then you're getting a business at a really cheap price that could deliver excellent free cash flow growth over the next several years. And given that it's trading at such a cheap price, your downside is relatively limited and the upside is much larger for long-term investors coming into this investment. This could also be a value trap where the price is cheap and it's only going to get cheaper, and the stock is falling and it's only going to fall further. So please do more due diligence on this investment. This is one of those higher risk investments that I talk about that have a high risk and could have a high reward if the geopolitical risks and other macroeconomic factors work in the company's favor. Hey everyone, if you like watching my videos, then I've added a great complimentary product just for you. I've created a book, I've written a book that's available for sale now that highlights my 6-step investing framework. Even if you don't follow that investing framework, just reading it and knowing how I evaluate stocks will make it a lot more interesting and informative to watch my videos. I've added the link in the description below.